Hello, fellow traders. We're going into the final month of the year. And as you know, December is window dressing month. That's the time when all the brokerage houses get rid of their losers, load up on the winners, and send letters out to their clients and prospects showing them how great their portfolios are. Window dressing. This coming week, beginning Monday, December 4th, there are a couple of announcements that you should pay attention to. The first one is on Wednesday, pre-market, the ADP unemployment report is due out. And on Friday, the U.S. Labor Department unemployment is due out. So let's go over to the chart. And this is my chart of the S&P E-mini. And I want to call your attention to, first of all, you're looking at my Friday chart showing the Taylor calculator. The projected support was down at 45.46, resistance up at 45.81, and again, as it usually is, Taylor's calculator is particularly accurate when it comes to the range. The range being the number of points between the support and the resistance levels, and I'm going to prove that to you by copying this range, and I'm going to transpose it up to the low of the day. Here it is, the low of the day, 45.63, and the market traded up and ended just about where the Taylor calculator forecasted would. And this has been true since George Taylor developed this system in the 1950s, and it's a very worthwhile tool to have for any day trader. So I'm going to get rid of this. And I want to call your attention to also one fact. You see that the prices traded well above the projected range. Now, why is that? Well, the reason is because the Fed funds rate, the target rate, is 5.25 to 5.50, and the December 13th meeting, which is the next FOMC meeting, the market projection is, or the market thinking is, that there's 99% chance that the Federal Reserve is going to hold steady on interest rates. Not going to necessarily lower them, but not going to raise them. Of course, if it lowers them, it's going to set off a real party going into the new year. But that is the reason that the market reacted as it did. And of course, you can see all the stop runs that have been put in. Look at this long tail on this candle here, this hammer over here as well. These are good indications that the market is going to go in a particular direction. Which direction? Up, of course. So I want to call your attention to something else. This month, we're going to go into the contract expiration. We've been trading the Z contract, and we're going to be rolling over the Z contract into the H contract. We're trading the ESZ23. You can see it here on my chart, on my watch list, the ESZ 2023. And on December 11th, this contract is going to roll over to the March 2024 contract, and that's going to be ESH 2024. You're going to change your chart, ESH 2024. Now, one more thing. For those of you who don't have the Taylor calculator, it's a very useful tool, as I always say, and you can get it at my site at timelessdollar.com. This is what the calculator looks like. It's a bit intimidating, as you can see, but in order to maintain it, you only need to update the date in the far left column and enter 4 numbers each day. All these calculations are performed automatically, and the day's resistance and support numbers are printed out on the corresponding rows together with the day's range, and you'll be able to track the Taylor forecast every day. And that is not just for the E-minis, but you can use it for any futures contract. You can use it for Forex as well, the stocks. The Taylor numbers work for just about any market. In my previous several videos, I noted where the S&P is in relation to the year's high. Now I'm going to go over to the S&P, the one-day candle. Okay, this is not the E-mini, this is the actual S&P. And I forecast, or I predicted, that the S&P was going to take out the previous high. The previous high was put in July, back in July. And the Dow has already taken out the high that the Dow put in July. The S&P is trading right at 45.99.33. Let's see the actual number. High 45.99.39. Okay, and the high of the year was 46.07. So we're 7 points away from the high of the year. And we can disregard those 7 points, but this is an area to pay particular attention to because we're really close to taking out this high. The market does want to go higher. I mean, there's no reason that it should go lower unless some announcement comes out that really gives traders the jitters. But the market should go higher into the end of the year. But, and remember, we have a month to go and we're trading right at the previous high. So just be a little cautious. The market could hit this 46.07 number and back off a bit. I think it will back off and go a little higher. But you should also be aware of the fact that there is a huge gap over here at 44.50. And that gap will eventually be filled, as will the one down here at 42.63. And there's another one over here at 43.32. These gaps will fill. Don't know when, not likely anytime soon, but they will fill. So that's my video, a little bit lengthy today. I think you can learn something, especially if you use the Taylor calculator and you get to become familiar with it. You can get it at my site at timelessdollar.com at this link on the nav bar. Okay, or from the home page, there's a banner at the bottom of the site right down here. So this is a tool that very, very valuable to have. And especially if you are new to trading, it's a little bit advanced. You might want to take my course first. I offer a free course, absolutely free, right over here, free trading course that talks about how to avoid the traps and the pitfalls that the market sets for you. For instance, stop runs. There are multiple stop runs every day, how to recognize them, what to do when you see them. So that's absolutely free. My full trading course is over here, the top link on the nav bar, on the drop down. You can get that as well. So if you are trading, remember, trade safely, use lots of patience, and I'll see you in my next video. Marv Eisen from Timeless Dollar Trading Academy.